Okay, let's unpack this because we're looking at a document today that essentially serves as the ultimate changing of the guard in modern business history.
Right. It really is.
Welcome to the deep dive. Our mission today is highly specific and honestly, it's a massive intellectual exercise. We are evaluating a legendary American conglomerate, but we are categorically rejecting the mindset of, a day trader who just watches red and green numbers flash on the screen.
Which is how most people look at it, unfortunately.
Exactly. Instead, I want you, the listener, to step into a completely different psychological space. Imagine you are a private buyer, you have absolutely unlimited resources, and you are evaluating this enterprise with the intention of buying the entire thing.
Every single piece of it.
Yes, every single railroad tie, every energy grid, every insurance policy, and every fractional business interest it holds. And your time horizon isn't next quarter. You are buying it to hold forever.
That is precisely the only appropriate lens for this evaluation. We must adopt a strict, unwavering long-term owner's perspective.
Oh.
And what makes our deep dive today so historically significant is our source material. We are dissecting the recently released 2025 Annual Shareholder Letter. It's dated February 28, 2026.
The end of an era, really.
Truly. For exactly 60 years, this document was the definitive intellectual property of a legendary founder who, alongside his fiercely brilliant partner, took a failing textile mill and engineered it into the most formidable compounding machine in American history.
It's just wild to think about.
And today, we are reading the very first letter written by the new Chief Executive Officer, Greg Abel. This is page 1 of the next 60 years.
I mean, I can't even fathom the psychological weight of sitting down to write that specific letter.
Oh, it must have been immense.
Right. You're stepping into an office where the fundamental framework of modern capital allocation was practically perfected. So how do we and how do you, as the hypothetical buyer, actually evaluate if the machinery is still intact?
You have to look at the foundation.
Exactly. To do this objectively, we're going to use the founder's own principles as our grading rubric. We'll evaluate 5 distinct pillars. First, management as stewards. Second, the economic moat. Third, capital allocation. Fourth, intrinsic value, specifically the rigorous defense of the margin of safety. And finally, we'll deliver a verdict on whether this remains a true compounding machine.
I love that structure. And if we connect this to the bigger picture, assessing those 5 pillars requires us to completely ignore the surface-level financial headlines that usually dominate the daily news cycle.
Oh, for sure. The noise is deafening out there.
It is. We're looking at an enterprise that operates 51 non-insurance businesses. It employs nearly 400,000 people, and it sits on hundreds of billions of dollars in cash and broad market indices.
It's basically a sovereign wealth fund at this point.
It is, for all intents and purposes, a microcosm of the global economy. But before we look at the physical infrastructure or the balance sheet, we have to examine the human element. A fortress of this magnitude is entirely dependent on the culture of the people guarding the gates.
Which is the perfect entry point into our first pillar, management as stewards. We really need to dissect the operating system of trust that Greg Abel has inherited. And let's be clear, he didn't just parachute in from a rival firm.
No, not at all.
His immersion in this highly specific corporate culture goes back to 1992 when he moved to Omaha to join an energy business. At the time, that energy company wasn't even part of the conglomerate.
Right, it was acquired later.
Yeah. He was mentored by Walter Scott Jr., who clearly instilled a very particular standard of leadership. But I have to ask, from the perspective of our buyer, does a resume from 1992 really translate to managing a $500 billion empire today?
What's fascinating here is how the new CEO actually frames those formative years. He explicitly states that his specific job titles or the daily tasks of the 1990s are irrelevant to his current role.
Okay, so what was relevant?
What he was actually doing was absorbing a form of capitalism that is deeply grounded in financial fundamentals, but entirely advanced by uncompromising values. He was learning the architecture of businesses designed to last across multiple decades.
Businesses spanning highly complex sectors, right? Like insurance, energy, railroads.
Exactly, and construction. By the time his energy company was inevitably acquired by the larger conglomerate, he wasn't an outsider learning the ropes. He was already fluent in the founder's specific language of capital stewardship.
And that language is heavily anchored in what the letter calls the partnership attitude. Now, look, I'm usually highly skeptical of corporate buzzwords. Every company says they value their owners.
Sure, standard PR.
Right. But they take this to a literal extreme. They explicitly state to the owners, your capital is commingled with ours, but it does not belong to us.
They are acknowledging a fiduciary duty that borders on the sacred.
They really are. But here is where my skepticism really kicks in and where I think you, as the prospective buyer, need to pay close attention. This is an operation with 400,000 employees. Yet, they run on a radically decentralized model.
Almost zero bureaucracy at headquarters.
Yeah, they pride themselves on having practically zero bureaucracy. From a purely operational standpoint, how does a conglomerate of this immense size not just immediately fracture into chaos without layers of middle management dictating strategy?
It's a highly counterintuitive structure, but it survives and thrives precisely because it lacks those central layers of control. You have to view the culture itself as the primary operating framework.
Explain that. What does that actually look like in practice?
Well, in a traditional corporate hierarchy, you have a sprawling headquarters dictating top-down, short-term earnings demands. You have subsidiary managers who are inevitably pressured to cut corners, delay maintenance, or, artificially inflate quarterly numbers just to satisfy central management.
Who are in turn trying to satisfy external financial commentators.
Exactly. This conglomerate's decentralized system is specifically designed to eliminate that pressure cooker, which they view as the primary driver of long-term value destruction.
So they just let the subsidiaries do whatever they want.
Autonomy in this system is granted based on deserved trust. The managers of these 51 businesses are given near absolute independence to focus relentlessly on their customers and their long-term operations.
But wait, absolute independence has to be paired with absolute accountability, right? Otherwise, you just have a bunch of well-funded rogue executives building their own fiefdoms.
Precisely. And the letter addresses this delicate balance. They minimize bureaucracy, but the trade-off is an expectation of total accountability and unwavering integrity and performance.
So the filter.
It acts as a massive psychological filter. This environment actively repels the type of executive who wants to hide behind committees, endless PowerPoint presentations, or consensus-driven mediocrity.
Oh, the classic corporate survival tactics.
Right. Conversely, it attracts exceptional operators who want the freedom to run their businesses exactly as if they were the sole private owners.
That makes sense in theory, but let's look at how it plays out in reality. The new CEO mentions a pivotal moment in 2018 when he transitioned to vice chairman, overseeing all the non-insurance operations.
The famous meeting.
Yes. He walked into a room, and the leaders of all these disparate businesses had the exact same anxiety. Is the decentralized model going to end? Are you going to start micromanaging us?
It's a valid fear when new leadership steps in.
Totally. And he had to assure them that he wouldn't, specifically because he had lived under that autonomy himself. He argues that decisions are simply fundamentally better made faster, with greater conviction, and grounded in superior knowledge when they are made by the local managers closest to the actual friction of the business.
Which is objectively true.
Right. You shouldn't have to wait for a committee sitting 3 states away to tell you how to price a product in your local market.
And the single binding agent that prevents this decentralized autonomy from turning into anarchy is institutional integrity.
Institutional integrity.
The letter references a legendary 1991 congressional testimony from the founder, which has essentially become corporate dogma. Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless.
That's a powerful mandate.
They don't treat integrity as some abstract moral concept. They treat it as an active, tangible asset on the balance sheet. It must be earned, continuously re-earned, and protected every single day.
That sounds great until human nature takes over. I mean, in a population of 400,000 employees, statistical probability guarantees that someone, somewhere, is going to make a profound mistake.
Oh, it's a mathematical certainty.
So how does this operating system of trust handle an actual failure of integrity or a massive operational blunder?
This raises an important question, and it's one a prospective buyer must scrutinize. The letter doesn't shy away from this reality. They define doing the right thing as actively rectifying errors when they inevitably occur. They don't claim to be flawless.
They claim to be highly responsive to their flaws.
Exactly.
And they provide a very tangible, frankly fascinating example of this with BNSF, their massive railroad infrastructure. They had a severe, long-standing dispute with the Swinomish Indian tribal community over crude oil shipments moving across tribal lands.
This is a textbook example of stewardship in action.
It really is.
Yeah.
Now, the initial decisions that sparked this hostility happened in the past under previous operational directives. A standard corporate playbook would dictate digging in your heels, hiring an army of lawyers, and engaging in a decade of hostile litigation to protect your right-of-way at all cost.
Just drag it out in court forever.
Right. But the current BNSF leadership fundamentally rejected that playbook. They chose a path to active integrity. They opened direct communication. They formally acknowledged the past mistakes. They issued an apology, and they structured a mutually beneficial agreement.
They stepped up.
They did. They secured the ability to meet their customers' supply chain needs, but they did so by respecting the parameters set by the tribal community.
If you were evaluating this as a buyer, that anecdote is incredibly revealing. It demonstrates a management team possessing the rare capacity to absorb the short-term ego blow of admitting a structural mistake in order to secure the long-term, multi-decade health of the enterprise.
Because fighting every single battle to the bitter end often destroys the broader war.
Exactly. A severed rail artery tied up in litigation is a dead asset. A respectfully negotiated settlement ensures the uninterrupted velocity of their rail network, which is the actual lifeblood of their cash flow. They are protecting the franchise above their own egos.
I see the value in that, but I want to push back on the broader philosophy here. We are looking at a hyper-decentralized model built on century-old principles. Meanwhile, we live in an era where almost every other massive global corporation is using advanced technology, artificial intelligence, enterprise software, real-time data feeds to radically centralize control.
The dashboard obsession.
Yes, they want to track every micrometric from a single centralized dashboard. Is this conglomerate just playing the role of a stubborn dinosaur, refusing to adapt to the reality of modern centralized data management?
I would argue they're playing a profoundly different game, one that inherently recognizes the limits of data. Centralization through technology certainly creates beautiful short-term efficiencies and looks great on a dashboard, but it simultaneously introduces massive long-term fragility. When you centralize decision-making, you strip adaptability away from the edges of your organization. If a localized supply chain shock occurs, a centralized manager has to wait for the data to populate, analyze it, and issue a directive. In this decentralized model, the local manager simply reacts instantly to reality.
That's a great point. The latency of centralized decision-making is a hidden cost.
But you are correct to point out the tension. As the new CEO notes, this structure only survives if the leaders genuinely reflect the enterprise's core principles. You absolutely cannot force this culture onto a traditional, metrics-obsessed corporate executive. You have to find operators who are biologically wired for autonomous responsibility.
Okay, let's assume we are satisfied with the stewards. They are disciplined, they treat the commingled capital with respect, and they value active integrity over bureaucratic control. But a brilliant management team can't save a fundamentally flawed business.
A great jockey still needs a phenomenal horse.
Exactly. So we need to transition from the people to the actual structural defense they have built. Let's dig into Pillar 2, the economic moat.
Evaluating the economic moat is the most critical technical assessment a long-term owner can make. You aren't just looking for a profitable quarter. You're looking for deep, structural, almost unfair advantages that insulate the enterprise from relentless competitors and macroeconomic shocks.
The wider the moat, the safer the castle.
And for this particular conglomerate, the bedrock of their financial fortress, the deepest, widest part of their moat is undeniably their insurance operation.
And we simply cannot talk about their insurance business without diving deep into the concept of float. If you are listening to this and mapping out your hypothetical acquisition, understanding float is mandatory.
It is arguably the most powerful financial lever ever utilized in modern corporate history.
It really is. Let's break down the mechanics. Imagine you run an insurance business. A client pays you a premium today to protect against a major catastrophe, say a massive hurricane. You collect that cash immediately. Right. You do not have to pay out a single cent until the catastrophe actually happens, which might be 5, 10, or even 20 years down the line. And statistically, for many policies, it may never happen at all.
So you're just holding their money.
Exactly. In the intervening years, you get to hold that mountain of cash, but more importantly, you get to invest it, and you get to keep 100% of the returns it generates. That pool of retained investable capital is float.
And the sheer scale of the float they have accumulated is almost difficult to conceptualize. At the end of 2025, their insurance float stood at an astonishing $176 billion.
Wow.
To put that in perspective, that pool of capital has doubled from $88 billion just a decade prior. It is a massive, continuously replenishing reservoir of financial power. However, it is vital to understand that float is only an asset if the cost of acquiring and holding it is fundamentally low.
Because if you're underwriting bad policies, it becomes a liability.
Precisely. If an insurance company is desperate for cash and writes highly risky policies with inadequate premiums, they will eventually pay out significantly more in claims than they collected. In that scenario, the float becomes toxic. It becomes incredibly expensive debt that will bankrupt the firm.
Which forces us to look at their actual underwriting performance for 2025 to see if this float is toxic or pristine. Across their vast property and casualty businesses, they achieved a combined ratio of 87.1%.
An incredible number.
So what does this all mean for you as the buyer? The combined ratio is the ultimate metric of insurance health. Anything under 100% means the insurer is generating an underwriting profit. It means for every single dollar they collected in premiums, they only paid out about 87 cents to cover claims and operating expenses.
So they're keeping 13 cents on the dollar just for running the business?
Right. Therefore, they generated a 13% profit margin on the insurance operations themselves, and they still get to hold and invest the $176 billion of float. They are literally being paid billions of dollars by their clients to hold and invest a $176 billion fund.
It defies the normal laws of corporate finance.
It really does. It's like borrowing money and having the bank pay you interest for the privilege of loaning it to you.
That 87.1% figure is not just a good year. It is an exceptional result, particularly for an underwriting operation of this immense global scale. It sits well below their historical long-term averages. And this structural advantage didn't happen by accident.
No, it's highly engineered.
It is the direct result of a highly specific risk playbook developed over decades by their top insurance executive, a man named Ajit. The true depth of this moat isn't simply the possession of capital. It is the institutional psychological discipline to accurately price catastrophic risk and, perhaps more importantly, the absolute willingness to walk away from the table when the market pricing is inadequate.
The letter emphasizes this point heavily. They write, "We often set a price today for a cost that may not be known for many years. We will walk away when the price is wrong." That ability to walk away is their ultimate superpower.
It's harder than it sounds.
Oh, absolutely. Most insurers are pressured by the market to continuously grow their premium revenue, even if it means taking on bad risks to hit a quarterly target. This conglomerate feels zero pressure to write bad business.
Not at all.
And because they possess unmatched, fortress-like financial strength specifically, over $370 billion in cash and U.S. Treasuries, they can retain massive layers of underwriting risk entirely on their own balance sheet. They rarely have to dilute their potential profits by purchasing expensive reinsurance from competitors. They operate as the ultimate financial backstop of last resort.
We need to pause and analyze that $370 billion cash position because it is frequently misunderstood. It is not idle money. It is a highly active strategic asset.
A lot of people see cash as trash in an inflationary environment.
Right, but in this context, it guarantees with absolute mathematical certainty that they will never be financially compromised, regardless of how severe a global economic depression or panic might become. They utilize debt incredibly sparingly across the holding company.
Which gives them unparalleled flexibility.
Exactly. They explicitly promise their owners that they will continually operate as an asset to the American economic system, never a liability requiring a bailout. That cash is infinite dry powder. When global markets panic and liquidity dries up, they are the only entity capable of acting decisively.
Let's shift from the financial moat to the physical infrastructure because they own tangible assets that are just as irreplaceable as their float. Take BNSF, their railroad. We aren't talking about a niche transportation company. BNSF is literally the circulatory system of the U.S. economy.
It's a staggering asset.
In 2025, that single asset produced $8.1 billion in net operating cash flows. But what I love about this letter is that it isn't just a victory lap. Management holds the railroad fiercely accountable.
They're not resting on their laurels.
Exactly. They note that while the operating margin improved to 34.5%, the gap between BNSF and the absolute best-in-class operators in the rail industry remains unacceptably wide. They know the exact math. Every single percentage point of improvement in that operating margin generates an additional $230 million of operating cash flow for the owners.
That shows a moat that isn't just wide, but has massive, untapped operational potential waiting to be optimized.
Right, the upside is huge just by getting better at what they already do.
And then you have to evaluate their massive energy utility operation, BHE. Their core mandate is to deliver highly reliable, affordable energy. But right now, they are standing at the epicenter of a massive, unprecedented investment cycle driven entirely by the technological explosion of artificial intelligence, hyperscalers, and massive data centers.
The energy demands for AI are just off the charts right now.
What's fascinating here is how they leverage their pricing power as a moat.
Yeah.
BHE currently delivers power to its residential and commercial customers at an astonishing rate, 24% below the national retail electric average.
A 24% discount to the national average is a staggering competitive advantage. And this is where the tension between their traditional infrastructure and the new AI economy becomes incredibly relevant. You have these massive tech behemoths demanding unprecedented amounts of electricity to run their server farms.
And BHE's response is brilliant in its structural discipline.
Yeah, they're essentially telling the tech world, we welcome your growth, but we are not subsidizing it. The billion-dollar infrastructure required to power your hyperscalers will be paid for directly by you, the specific customer.
They are aggressively protecting their everyday households and small business consumers from footing the bill for the tech industry's expansion. They will commit capital to build the grid, but only when the risk-reward ratio is perfectly balanced in their favor.
It's a perfect illustration of how they define operational excellence. For this enterprise, operational excellence isn't a vague motivational poster. It is the ability to execute complex, capital-intensive projects under extreme pressure without compromising the core business model.
Which brings us to an incredible story in the letter about Precision Castparts, a massive, highly complex manufacturing business they own.
Oh, this story is wild.
In February 2025, a devastating fire broke out at their primary forging facility in Pennsylvania. We aren't talking about a minor disruption. This specific facility was responsible for producing more than 700 parts that were sole-sourced.
Sole-sourced, meaning nobody else on Earth makes them.
That means they were the only facility on the planet making these specific, hypercritical components for major aerospace manufacturers. If the supply of those 700 parts stops, the global manufacturing lines for commercial airplanes literally grind to a halt. The economic ripple effect would be catastrophic.
How they responded to that crisis is a masterclass in the exact decentralized management we discussed earlier. First, they ensured every single employee was evacuated safely. They provided immediate, massive support to the local first responders and initiated rigorous environmental testing to protect the surrounding community.
That's the stewardship pillar in action right there.
But from a purely operational standpoint, the CEO of Precision Castparts and his local team didn't wait for headquarters to formulate a global strategy. They immediately, almost violently, redistributed the manufacturing of those 700 highly specialized parts across their vast network of domestic and international facilities.
And the ultimate outcome: not a single major aerospace customer experienced a production line stoppage.
It's hard to believe, honestly.
Let that sink in. Your primary sole source factory burns to the ground, and your global customers don't even miss a beat in their supply chain. The letter rightfully highlights this as the ultimate stress test of their model. Decentralized leadership, taking immediate ownership, clear lines of accountability, and flawless execution.
That level of resilience is the most impenetrable part of their moat. You cannot simply buy or replicate that kind of operational muscle. It has to be forged over decades.
So if you are our prospective buyer, you have now established that the stewards are unimpeachably trustworthy, and the economic moat, comprising both financial float and irreplaceable physical infrastructure, is incredibly deep, generating rivers of free cash flow.
Which naturally forces us to examine the single most important duty of the chief executive officer. This brings us to Pillar 3, capital allocation. When you have an enterprise throwing off tens of billions of dollars in cash every year, what do you actually do with it?
To understand their approach to capital allocation, we have to revisit a classic framework the founder always championed: the Ted Williams playbook.
Ted Williams, the legendary baseball Hall of Famer.
Right. He wrote a book called The Science of Hitting. He mathematically divided his strike zone into 77 distinct baseball-sized segments. He realized that if he swung at pitches in his less favorable zones, his batting average plummeted. But if he exercised extreme patience and only swung at pitches that landed dead center in his happy zone, he batted over 400. He didn't have to swing at every pitch just because the crowd was yelling at him.
That specific discipline is the absolute foundation of their investment philosophy. Every single day, market fluctuations and investment bankers are throwing pitches at this conglomerate. But they are perfectly content to stand at the plate, bat resting firmly on their shoulder, clutching their $370 billion in cash, and simply watch pitch after pitch go by.
They will not swing until they see an opportunity that lands squarely in their preferred zone.
And when it finally does, they swing with massive, concentrated force. So what exactly constitutes a happy zone pitch for an enterprise of this size?
The letter clearly outlines 5 non-negotiable capital allocation principles. Number 1, the business must be thoroughly understandable with deeply durable economic advantages.
So no hyper-speculative tech trends they don't understand.
Exactly. Number 2, it must be run by high-integrity leaders who already act like owners because, remember, headquarters isn't going to manage them.
Right, the decentralization requires it.
Number 3, they strictly avoid any business that poses a risk of societal harm or could jeopardize the immaculate reputation of the broader conglomerate. Number 4, when they decide to act, they move with lethal speed, offering absolutely no financing contingencies.
That's a huge advantage in deal-making.
Huge. If they want to buy a $10 billion company, they simply wire $10 billion in cash. Done. And number 5, they maintain strict pricing discipline and then step back to let the math of compounding unfold over decades.
We saw this rigorous playbook executed flawlessly in 2025 with 2 distinct acquisitions. The first was OxyChem, a highly efficient industrial chemicals business that produces essential materials like chlorine and caustic soda. It operates in a fundamentally essential market, the existing management team is obsessed with efficient execution, and the business generates incredibly compelling cash flows.
It is the quintessential heavy industrial addition to their portfolio that perfectly aligns with their understanding of physical infrastructure.
But the second acquisition, here's where it gets really interesting and frankly a bit amusing. In 2025, they acquired a company called Bell Laboratories.
Not the famous tech research lab, to be clear.
No. How did this massive $500 billion conglomerate find this deal? The CEO of Bell Labs simply sat down and wrote a well-crafted letter to headquarters. And what is the core business of Bell Labs? Rodent control.
They bought a rat-catching business.
They bought a family-owned rat-catching manufacturing business. Now, why would they ignore flashy AI startups to buy a pest control company?
It sounds absurdly mundane for a conglomerate of this scale, but if we analyze Bell Labs strictly through those 5 principles, it is the definition of a happy zone pitch. In his letter, the Bell Labs CEO described his operation as having exceptionally high operating margins, a long history of consistent growth, a business model that is instantly understandable, and most importantly, a product that is always needed.
Always needed. That is the magic phrase. Think about the tension we discussed earlier between tech and tradition. Bell Labs is completely biologically immune to technological obsolescence.
A rat is always a rat.
Right. You don't have to lie awake at night worrying that some teenager in a garage is going to code an app that digitally disrupts the global demand for rodent control. Rats will always exist, and people will always pay to get rid of them. The conglomerate recognized durable advantages run by excellent managers. Their only documented complaint about acquiring this rodent control business was a testament to its quality. We only wish it had been 10 times bigger.
That specific quip about wishing it were bigger highlights a profound structural challenge that we must address, the brutal reality of their sheer size.
Yeah, the math gets harder the bigger you get.
Finding an outstanding business that meets all 5 criteria is available at a reasonable price, and it's fundamentally large enough to actually move the needle on a balance sheet approaching $1 trillion is nearly impossible.
Which perfectly explains why financial commentators look at their $370 billion in cash and constantly accuse them of losing their touch, of retreating from the market, or being too fearful to invest.
Oh, the financial press loves to push that narrative. They've lost their edge. Why aren't they putting that cash to work?
But the CEO shuts that noise down completely in this letter. He writes, "Many times in our history, observers have suggested our substantial cash position signals a retreat. It does not. I think people deeply underestimate the immense psychological restraint required to hold hundreds of billions in cash while the rest of the world is getting rich on speculative assets.
It takes iron discipline.
They are remaining fiercely patient. They absolutely refuse to swing at mediocre, overpriced pitches just to generate headlines or look busy.
And we must extend this analysis of capital allocation to how they manage capital that they have already deployed. We aren't just talking about buying whole companies. A massive portion of their value is derived from their portfolio of fractional ownership interests in other publicly traded mega-cap companies.
They act as passive, highly concentrated owners of some of the greatest businesses on Earth.
The letter specifically highlights their massive permanent stakes in entities like American Express, Coca-Cola, and Apple.
Let's quantify the scale of those fractional stakes, just so our buyer understands the magnitude of what they are acquiring. This conglomerate essentially owns 22.1% of American Express. They own 9.3% of the entire Coca-Cola company. And they hold massive, highly strategic fractional interests in 5 major Japanese trading houses.
Mitsubishi, ITO-CHU, Mitsui, Marubeni, and Sumitomo.
Exactly. They own roughly 10% of each of those massive global entities.
I want to dive deep into those Japanese investments because they represent a masterclass in macroeconomic capital allocation and risk hedging. They didn't just take U.S. dollars and buy Japanese assets, which would expose them to massive currency fluctuation risk.
Which can wipe out your gains even if the business performs well.
Instead, they executed a brilliant structural hedge. They borrowed roughly the equivalent amount of Japanese yen in the local credit markets to fund the purchases. Because of Japan's specific monetary policy, they secured this debt at an incredibly low average cost of just 1.2%.
Okay, let's unpack this because the mechanics here are genius. They borrow money in Japan at 1.2% interest. They use that yen to buy 10% stakes in these highly profitable, dividend-producing Japanese trading houses.
The dividends and the earnings growth of those businesses far exceed the 1.2% cost of the debt.
The spread between the low interest rate and the high business return is pure, unadulterated profit. And because the asset and the debt are both denominated in yen, it doesn't matter if the yen crashes or skyrockets against the US dollar. The currency risk is completely neutralized.
It's a closed loop of value creation.
Taking all these major fractional positions together, at the end of 2025, they totaled an astonishing $194 billion in market value, pumping massive, consistent dividends straight back into the conglomerate's fortress balance sheet. They apply the exact same rigorous discipline to buying fractional units as they do to buying a rat-catching business. Understand the economics, trust the managers, and let it compound over decades.
But an honest evaluation of management requires us to look at what happens when capital allocation goes wrong, because it does. The new CEO displays essential candor when discussing their acquisition of Pilot, the massive travel center and truck stop operator in North America.
They initially invested in Pilot back in 2017.
Right. However, the structure of the contract severely delayed their ability to actually take control and manage the daily operations until 2023. Greg Abel bluntly writes that mistake will not happen again.
That level of candor is so rare in corporate communications. By publicly acknowledging that the structural delay was a fundamental error in deal-making, he signals to the continuing owners that the capital allocation process is continuously evolving and being refined. They aren't trying to bury their mistakes.
They're learning from them in plain sight.
And since finally taking operational control, they haven't just extracted cash. They have massively increased capital spending to modernize Pilot's entire network and build out extensive electric vehicle charging infrastructure. They are actively treating it as a multi-decade asset, not a short-term cash cow to be milked.
So as our hypothetical buyer, you have observed incredible discipline in how they deploy capital. They wait for the perfect pitch, they structure brilliant macroeconomic hedges, and they own their mistakes. But capital allocation is only truly successful if the price you pay is mathematically sound.
Buying the greatest business in the world at an exorbitant price guarantees a terrible investment return.
This crucial distinction transitions us directly into Pillar 4, intrinsic value versus price, and the absolute necessity of protecting the margin of safety.
This is where we really have to roll up our sleeves because it's arguably the most technical, yet fundamentally vital, part of understanding what this enterprise is actually worth. We have to separate the artificial accounting reality from the true economic reality.
The accounting rules can be incredibly misleading.
The letter issues a very stark warning. Owners must treat GAAP net earnings generally accepted accounting principles with extreme caution. In fact, the founder used to call JAP earnings in this specific context worse than useless.
Let's explain why that is, because for an enterprise holding $194 billion in fractional business interests, the standard accounting rules create massive distortions. In 2018, the Financial Accounting Standards Board mandated a rule change requiring companies to include the unrealized paper gains and losses of their equity portfolios directly in their net income statement every single quarter.
Which means, if you just read a headline on a financial news network, the numbers look completely chaotic. If the broad market indices happen to take a severe dive in December, this conglomerate has to report a massive multi-billion-dollar loss in their net income.
Even though they didn't actually sell anything?
Exactly. The headlines will scream that they are bleeding money, even if they're actual operating businesses. The railroads, the energy grid, the insurance float just had the most profitable cash-generating year in their entire history. The accounting rules force them to report a paper loss that has absolutely zero impact on the actual cash flowing into their vault.
Precisely. To value this enterprise as a sophisticated private buyer, you must aggressively strip away that accounting noise. You have to look exclusively at the actual cash it generates from operations. In 2025, when you ignore the paper fluctuations, their operating earnings were a remarkably steady $44.5 billion.
That's the real engine running.
More importantly, they produced $46 billion of net cash flows from operational activities. That $46 billion is the undeniable economic reality. That is the hard currency being pumped into the fortress. Evaluating intrinsic value requires an obsessive focus on that cash generation, completely ignoring the quarterly mood swings of the broad market indices regarding the fractional interests they plan to hold forever.
And how does management utilize this rigorous intrinsic value calculation to directly benefit the continuing owners? This brings us to the mechanics of repurchasing their own ownership units. Now, a lot of corporations buy back their own units just to artificially inflate their per-unit earnings metrics to trigger executive bonuses.
It's a very common corporate game.
But this enterprise operates entirely differently. They have a strict mathematical policy. They will only deploy capital to buy back their own units when they trade, quote, below our estimate of intrinsic value, conservatively determined.
The underlying mechanics of this are vital to grasp. Think of the enterprise like a massive private real estate syndicate that you are a partner in.
Okay, I like this analogy.
If the syndicate uses its internally generated rental income to buy out a retiring partner at a price that is significantly below the actual market value of the underlying buildings, the remaining partners like you, the listener in our scenario, instantly own a much larger percentage of the cash-flowing properties.
Your slice of the pie gets fundamentally thicker.
Your fractional ownership of the total rental income increases permanently, and you didn't have to write a new check or deploy a single dollar of your own additional capital.
It is the ultimate form of stealth wealth creation for the long-term owner. Your stake gets richer. But, and this is the most critical caveat in finance, it only works if the syndicate buys out the exiting partner at a strict discount.
The margin of safety.
Yes. If they overpay for those units, they are literally destroying the wealth of the remaining partners. That is exactly why the margin of safety is so paramount. The purchase price must be demonstrably below a conservatively calculated intrinsic value. Otherwise, the cash is better left sitting in U.S. Treasuries.
We see this exact same adherence to strict value creation in their approach to dividends. The enterprise famously does not pay a cash dividend. Their policy is unapologetically mathematical. They will retain all earnings as long as management believes that retaining $1 of earnings will translate into more than $1 of long-term market value for the owners.
They are essentially making a bold, mathematically backed promise to the owners.
Because of our moat, our lack of bureaucracy, and our capital discipline, we can compound this single dollar far more effectively inside our fortress than you ever could if we handed it back to you to invest on your own.
But protecting the margin of safety isn't just a spreadsheet exercise regarding unit prices or dividends. It's deeply tied to existential risk management. The letter makes a very definitive statement regarding the new CEO's role. It says, the CEO is responsible for serving as chief risk officer. There is no more important duty.
If we connect this back to our earlier discussion on the decentralized model, this statement is profound. In their system, the local operating businesses assess and manage their specific daily risks. But the CEO, sitting at headquarters, must look at the entire chessboard.
They have to see the interconnected risks.
He must ensure that no single localized risk or any disastrous combination of correlated global risks could ever threaten the financial fortress or the pristine reputation of the enterprise as a whole. Risk management is the ultimate margin of safety. When your time horizon is measured in perpetuity, survival is the only metric that matters.
And part of that rigorous value assessment is, once again, the willingness to look in the mirror when a massive capital allocation goes poorly. The letter specifically addresses their major investment in Kraft Heinz. They don't try to spin the narrative or blame macroeconomic headwinds. They flatly call the performance disappointing and openly admit that the return on capital has been well short of adequate.
It's refreshing honesty.
As a prospective buyer, that is exactly the kind of sober assessment you demand. You cannot afford to partner with a management team suffering from institutional self-delusion. Publicly acknowledging a multi-billion-dollar misstep proves that they respect the margin of safety enough to face the brutal facts of reality.
So we have thoroughly analyzed the architecture of this empire. We have evaluated the decentralized stewards and their active integrity. We have plumbed the depths of the economic moat, driven by cost-free float and irreplaceable physical infrastructure. We have reviewed their disciplined, happy zone capital allocation, and we understand their uncompromising devotion to intrinsic value and the margin of safety.
Which means we're at the end of the rubric.
We have arrived at the fifth and final pillar of our deep dive, the ultimate verdict. We must answer the core question for you, the buyer. Is this enterprise still a true compounding machine?
To answer that, we first have to respect the historical track record because the math is almost hallucinatory. From 1965 through the end of 2025, this enterprise generated a compounded annual gain of 19.7%. Over 60 straight years, that translates to an overall cumulative gain of 6,099,294%.
We need to let that number truly sink in. 6 million%. To provide context, the broad market indices over that exact same 60-year period with all dividends reinvested grew by roughly 46,000%.
Which is great, but it's a rounding error compared to 6 million.
The historical outperformance of this conglomerate is a statistical anomaly in the history of capitalism. However, as the new CEO astutely and honestly points out, past performance of that magnitude cannot dictate the future, especially when you are dealing with a balance sheet of this immense size.
Right. And here is the brutal, unavoidable truth of scale, which the letter plainly acknowledges to the owners. At our scale, the math of compounding works against us. It's a fundamental law of financial physics. You simply cannot compound $500 billion of equity at 20% a year for very long before you literally run out of massive, profitable assets on planet Earth to acquire.
The sheer gravity of their size limits their velocity.
The machinery has fundamentally, irreversibly shifted. It is no longer a hypergrowth vehicle designed to aggressively outpace the global economy. The letter explicitly states that their future opportunity is improvement in per-unit value over the long term, even when progress comes in smaller increments, with a constant focus on managing downside risk for our owners.
So what does this all mean for you, the prospective buyer sitting here today? If it's never going to grow by 6 million% again, why would you deploy your unlimited resources to acquire it?
Because it's transformed into something else entirely.
Exactly. You buy it because it has successfully transitioned into the most robust, unstoppable wealth preservation and steady compounding vehicle ever constructed. What does compounding look like when progress comes in smaller increments? It means fiercely leveraging that operational excellence we discussed earlier.
Squeezing every ounce of efficiency out of the existing assets.
It means methodically squeezing 1 extra percentage point of operating margin out of the BNSF railroad, which reliably generates hundreds of millions in incremental cash. It means reinvesting in the energy grid at guaranteed rates of return. It means methodically repurchasing fractional ownership units when the price is irrationally low, slowly and safely concentrating your stake without risking capital.
The real product this enterprise sells to its owners today is not hypergrowth. It is absolute financial invulnerability and a good night's sleep. A fortress that compounds while you sleep.
It's the ultimate defensive asset.
What an incredible journey. We've evaluated this magnificent conglomerate through the strict lens of a private buyer looking to hold forever. We found a fortress balance sheet armed with $370 billion in dry powder. We found a highly decentralized, bureaucracy-free management team that operates with fierce accountability and active integrity.
The culture is intact.
We found unparalleled capital discipline, a team perfectly willing to wait years for the perfect pitch, and an uncompromising mathematical respect for intrinsic value. Whether you are evaluating a multi-billion-dollar international conglomerate or a small local business in your hometown, these principles, stewardship, moat, disciplined allocation, and margin of safety, are the ultimate toolkit for you to understand business at the highest level.
As we conclude this evaluation, I want to leave you with a final, perhaps somewhat provocative thought to mull over, something to explore long after this discussion ends.
I'm ready for it.
The foundation of this entire enterprise, from its commingled capital to its decentralized autonomy, is built entirely on the philosophy of perpetuity. The assumption that you buy great assets to hold forever.
Right.
But we live in a world where the lifespan of the average corporation is shrinking rapidly, pulverized by technological disruption. We discussed earlier how their energy division must navigate the demands of artificial intelligence, and how their acquisitions favor anti-obsolescence, like pest control.
Yeah, Bell Labs.
The underlying tension is profound. Can a corporate culture built on extreme patience and century-long horizons continue to thrive in an emerging economy defined by artificial intelligence, instantaneous data, and unpredictable exponential change?
Whoa.
If their decentralized culture truly is their greatest asset, the next decade of hyperfast technological evolution will be its ultimate stress test.
Wow, a stress test of century-long patience versus instantaneous velocity. That is a brilliant and challenging question to end on. Thank you so much for joining us on this deep dive. Keep questioning, keep analyzing, and we will catch you on the next one.